Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Wednesday, the 29th of April. I'm Daniel Lam, your host for the podcast. This week is flooded with key central bank meetings, as well as reporting from prominent hyperscalers later in the week. Now, yesterday, the Bank of Japan, the BOJ, voted to keep its benchmark interest rate unchanged at 75 basis points. But the surprise was the vote division. A 6-3 vote represents the biggest divide under Ueda's governorship. This suggests that there is increasing pressure to normalize policies, especially in such a fundamentally undervalued currency as in the yen. Now, this division of the vote had to do with the inflationary pressure that Japan is facing. In fact, the BOJ raised its forecast for core inflation to 2.8% for this fiscal year, which was more than expected. At the same time, they toned down their growth forecast. So what to do? Should they try to support growth by keeping monetary policy easy? Or should they be hiking rates to control inflation? Adding to the complications, of course, are the uncertainties in the Middle East. How long would the conflict continue? How fast would the US and Iran come to some sort of agreement? My view is that the BOJ cannot ignore inflation. Japan relies heavily upon imported oil, and a weak yen can only add to the pressure. Now, historically, the BOJ intervened when the dollar-yen went above the 160 level, and we're expecting them to do so again should the dollar-yen go above. Yes, the BOJ would like to buy time and stand pat for this meeting in order to seek more clarity, especially on the Middle Eastern front. Hence, the rate hike is delayed but not averted. Now, the BOJ said that it would keep hiking rates in response to developments in the economy, i.e., they will be observing and then act accordingly. Our CIO team is forecasting 2 rate hikes to 1.25% by December this year. On the US, inflationary pressure is more transitory. Job markets are at a fragile equilibrium with decelerating wage growth and shelter inflation. The de-escalation in the Middle East means the US soft landing story is reasserting itself. Finally, the new Fed chair would likely attempt to revive the job market. Therefore, we are projecting 1 rate cut from the Fed by the end of 2026. So to synthesize all these, the dollar-yen faces downside, i.e., the yen is likely to appreciate versus the US dollar. And on a 12-month horizon, we believe the dollar-yen can go to 152. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.